another week to take a look at what's happening in the world of business. This is Moolah Insider, where we're all about personal finance and your relationship with money. My name is Mercy Milanoy. This week, it's all about the national budget for the financial year 2021-2022. We take a look at the proposals and the major highlights that have been proposed in this particular budget. And of course, how will this affect you and your expenditure and your money? Stay tuned. There are proposals and amendments that have been suggested, especially in the Finance Act for 2020, that will affect you. First up is the expansion of the tax rebate and apprenticeship. Under the new proposal, an employer who hires at least 10 university or technical and vocational education training students for a period of 6 months or more in a particular year of income shall be eligible for tax rebate in the year subsequent to the year of such engagement. Previously, an employer would qualify for this rebate if they hired at least 10 university students. So what does this mean? First, it's a win-win. The employer will have a bigger pool to pick from students to hire, while at the same time continue to enjoy a tax rebate. The effect date for this to take place that has been proposed is January 2022. The other proposal that has been made in the Finance Act for 2020 is the imposed income tax that will affect businesses operating especially in the electronic systems, aka online businesses. The bill proposes to impose income tax on income accruing from businesses carried out over the internet or an electronic network, including through a digital marketplace. The bill proposes a new definition for digital marketplace. A digital marketplace will mean an online platform which enables users to sell or provide services, goods, or other property to other users. The implication of this is that it will bring into the ambit of taxation merchants who use social media platforms to market their products and services and generate income from such an activity. The implications of this will mean there's a likelihood that consumers will bear the brunt of this measure. The other proposal that has been made on the Act is the removal of the 10-year limit for tax. What basically this means is that the bill proposes to eliminate the 10-year limit provided to utilize taxable losses. The implication of this is that the proposed change will enable taxpayers to offset taxable losses against future profits until they are fully exhausted. The proposed date for this is 1st July 2021. Still on the Finance Act 2020, the other proposal that has been made is on insurance relief, especially for your NHIF contributions. The bill proposes to extend insurance relief to include NHIF contributions. The implications of this: first, it is a welcome proposal as it will cover a majority of Kenyans who pay NHIF contributions but are unable to enjoy the insurance relief accorded on premiums paid to other life insurance schemes. The proposal will also lead to higher net pay for employees due to the insurance relief being applied on NHIF contributions deducted through the payroll. The proposed date for this move is 1st January 2022. There are tax rate changes that have been proposed, and this means that there are goods and services that were once zero rated but now are taxable, while others were taxable but now they are zero rated. So which are these goods and services? First, let's start with those goods and services that were zero rated but now they've been removed and now they are taxable. So these goods include bread, liquefied petroleum gas, also known as LPG, materials for the manufacture of automotive and solar batteries. What this means is that these particular goods have now moved from 0% and will now attract 16% tax. On the other hand, there are goods and services that once attracted VAT, but now they will be zero rated, meaning they won't attract any tax. These include maize corn seeds and also ambulance services. The proposed date for this to take effect is 1st July 2021. Finally, one of the other proposals that will affect you, particularly for this one, is the income tax proposals that have been made. And this basically means removal of existing tax incentive, that is income exempt from tax, which is under Clause 8, includes several types of existing income that is exempt from tax are proposed to be removed, with the effect of making a tax saving of about 1.5 billion shillings, mostly these to the taxpayers. So some of the things that have been exempted include income for a registered home ownership plan, income of NSSF, and bonus, overtime, and retirement benefits not exceeding 10%. So these are just some of the proposals that have been made, especially in the Finance Act 2020. And once they're approved by Parliament, they will take effect. A lot of concerns have been raised, particularly for this budget for the financial year 2021-2022. Most of the issues that have been raised include on debt and also on the tax measures. To give us insight on this, we have two experts, one a tax partner, and of course, one who is the CEO of Institute of Public Finance in Kenya. Now, to give us insight, especially on debt management in the country, we are now joined by James Muraguri, who is the CEO of the Institute of Public Finance in Kenya. Thank you so much, James, for joining us. First up, what is the state of debt in the country?
Borrowing is no problem. We can see when we borrow, what we are doing. For example, we can see that. So borrowing is not problem. The problem is your capacity to pay. And that's what I would like citizens to understand. Our capacity to pay. Right now, our capacity to pay is shrinking because we are not correcting revenue taxes as faster as we are borrowing. And remember, when you borrow, you have the question of principal and interest. Now, when you borrow, you can borrow again. Let's say, if I borrow from Peter, when it comes to paying Peter, I can borrow from Paul to pay Peter. And then Peter will give me another 5 years to pay him. And when it comes to 5 years to pay Peter, I can go back to Paul and borrow and I will continue like that. So borrowing doesn't have a problem. The problem is our ability to pay the interest that comes. Because Peter will give me at 5%, Paul will give me at 7%. Now, you cannot refinance interest by borrowing because that, again, is not sustainable. So that would be the challenge. Currently, we are spending around 60% of our taxes. As we continue borrowing, it means because our interest is increasing, then we have to borrow more, up to 100%. Then you find all our taxes are going to pay interest. Not even on principal, because principal we can borrow and refinance. But then there comes a problem, because then if we are spending 60% of our internal taxes to finance debt, it means then that we default on providing medicine to the deserving citizens. If I walk to my local dispensary, I can't, because there's no medicine. The government spent all the money in paying the debt. So borrowing is not the problem. And we can see the SGR, for example. We can see the roads being constructed. That's not a problem. But the question is, when the debts fall due, are we able to pay? That's the biggest problem.
Take us through the tax bracket expansions and how will this affect taxpayers?
The problem with that approach is that you're digging deeper instead of digging wider. So you're already targeting the person who's paying taxes. Literally you're killing that person who's in business already. We should be asking ourselves, how do we expand our tax bracket? Expanding our tax bracket, first of all, includes removing tax breaks that we give to multinationals. There are companies here who are registered, for example, in Mauritius, they pay 1% tax, while my small business or your small business pays 30%. So, and the amount of money they make is huge, and then they chip it out, all of it. We need to ask about those tax breaks. Then we need to ask ourselves with regard to our property taxes. How coherent is our property taxes? Also, about inheritance tax. It's time we also started having a conversation on inheritance tax. All what we see in the newspapers is families fighting over billions of inheritance because no one has, no one makes that money, so you just want to fight. We lead cases that are in courts for 40 years, since 1980s.
To continue with the conversation on tax, we're now joined by Francis Kamau, who is a partner and a tax lead for East Africa at Ernst & Young. And basically, Francis, what we'd like to know is, yes, we know the government wants to expand the tax bracket, but how can they do this without overtaxing the already taxed in the country?
Maybe one thing I can commend the government is the way they expanded the brackets of individuals by ensuring that the lowest taxed person, actually the lowest tax income is actually raised. So that, of course, when you're moving from around 16 to around 29,000 in a month, I think that was a good way of dealing with it, of ensuring that at least the people who earn less than 29 to 20,000 or thereabout are not taxed. So that was a good move. But having said that, the brackets, if I look across for individual across East Africa, we are not badly off. Actually, because of the strength of Kenya shilling, we're still better off if you look at the countries of Kenya, Uganda, Tanzania, Rwanda. We are still somewhere, so to speak. But my question has been, do we need to compare ourselves with those countries? We need to look for the Asian tigers. We need to look at the Singapores of this world, Thailand, Indonesia. I mean, those countries and how they are approaching it. And what they have done is to ensure is that you reduce the bracket. For example, at least if you're able to reduce the highest taxable rate to 20, and again, at the same time, you maintain the expanded brackets the way they are, that would be very good for the people who are paying taxes. But let's just ask ourselves a question. When you look at the voters, we already have around 20 million voters, but the taxpayers are around 3.9. That means there are so many adults who are not paying taxes. How can you bring them to the tax bracket? One of them, which make it very, very easy, is a government action of ensuring that whether you're calling to Huduma number, the Germans call social security number, that everybody is somehow registered and a PIN. And if you don't have a PIN, at least you can't do transactions. So that is the bottom line. Then the government to share information that wherever you are basically selling a house, wherever you are going to Narok, to sell that cattle at the auction, and wherever you are trying to sell your tea, the government is able to capture all that information to say that Ole Sadok has sold 200 cows. I mean, that is information which can be captured at even the county level, so that Ole Sadok is able to pay taxes with a sale of 200 cows, when we have a Joroge here in Nairobi who is earning a mere 30,000 and is being taxed. So that you expand the bracket to the people we cannot reach, so that we share this burden. Actually, somebody was saying that if you look at the employed people, you can even see by the gait and stoop when they are walking the streets, because they are carrying the weight of government bear. So we need to expand, and the governments need to work with the Kenya Revenue Authority to avail all those transactions.
To close this discussion, what is the impact of the Finance Bill 2020, particularly at the grassroots level? How does this affect each and every one of us?
There is no much impact from the grassroots perspective. Of course, there are a number of issues which have been touched, like LPG. Of course, that one is a kicker to Wajiko. We have also the issue of bread, which basically is affecting Wajiko. So the broader, the direct issues are those ones, which of course are unfortunate, but they are not many. Now, the biggest pie where Wajiko is going to be affected is indirectly. Once you kill a manufacturer, it is Wajiko who works there. So from outside the processes, when you kill a wind operating company, and I'm not naming names, I'm an advisor to some, that entity is assisting 1,001 communities out in the arid areas or semi-arid areas. So it's that massive thing that Wajiko should be able to feel. He's going to feel a lot of pressure, which is not direct. Loss of jobs. Sometimes electricity would go up. So many things will happen which are outside the direct shilling. When you basically come to the manufacturer who is told to pay minimum tax as per the previous Finance Act, and of course previously they were claiming capital deduction, and they are not able to sustain 100 people they employ, they are not able to sustain 50. Of course, Wajiko will be affected, because what happens, and you need to be proved wrong, one employee in Kenya supports 5 people at minimum. So you lose your job, 6 people cannot eat. Because, I mean, you're supporting 5 and you're 1. Those are 6 people. When you basically lose 100, each company is losing a number, then it is a ripple effect in the entire economy.
One of the things that we'll be looking out for, particularly this week, is how the government plans to raise, while at the same time spend the budget for the financial year 2021-2022. And one of the things that we'll be hearing a lot is a fiscal policy, and that is the word of the week. So what is fiscal policy? It refers to the use of government spending and tax policies to influence economic conditions, especially macroeconomic conditions, including aggregate demand for goods and services, employment, inflation, and economic growth. Remember, you are watching Moolah Insider, and if you haven't watched our previous episodes, remember to log on to www.moolah.co.ke and link with us on our social media pages. Up next is Pursuits. You are watching Moolah Insider. On our episode of Pursuits, we tell you about Waweru Nderitu. Initially, it began as a journey to find his wife some space in the CBD for her cosmetic business. Well, they were met with a very rude shock of the high cost of doing business in the CBD. But they stumbled upon something, the beauty of sharing a space. Take a look. 4 years ago, Waweru Nderitu decided to help his wife set up a cosmetic business in Nairobi's central business district.
She used to store them at home, so one of the bedrooms was actually our storage. So she had just piles of products, and anytime a customer bought her product, she used to sort delivery from the house to where the client is. And over time, when your business starts growing, you realize it becomes unsustainable. So yeah, that's what now necessitated for us to come and look for a shop in town. And that's when we realized it's a bit expensive.
Someone looking to establish a business with premises in Nairobi's central business district immediately comes up against a long budget. There are two main categories of payment, the first being to the landlord or agent, who usually ask for goodwill payment and 3 months' rent. Next, the local authority, in this case, the Nairobi City County Government, will need a list of things paid for. There is business permits, a signboard fee, a wall painting fee, a garbage dumping fee, a clearance certificate from fire department at the county government, which can cost between 4,500 and 25,000 shillings. The cost of the licenses and fees can go up to 50,000 shillings. These challenges hamper the growth of small and medium enterprises, which play a critical role in the economy. While they constitute 98% of all registered businesses in Kenya and employ 30% of the country's youth, 75% don't get to celebrate their third birthdays, with many of these deaths because of the often high cost of doing business. After Waweru and his wife had considered and paid up all the cost, they had learned a few lessons.
Because we felt at that point rent was her biggest expense, we thought, if we can reduce the cost of rent, she'll be able to run her business successfully. 6 months later, we realized, okay, cosmetics is do away with it. Now we realized we've stumbled into something. We have something that has value in the marketplace. And so that's when we started now doing Notify Logistics. We registered as a company, we focused on space particularly, and it's been a learning experience.
The concept behind what they do now is fairly simple.
We decided to take a shop, and what we do is we partition it into shelves. Then we allow for hundreds of businesses to co-share that space efficiently. So instead of owning the whole shop, you only take a shelf, you pay for that shelf without really minding about the overheads of the shop. So it's a fully serviced retail outlet. You only pay for your space, we provide the shop attendants, we provide the licenses, everything else has been catered for. You only stock in your shelf, put your products there. If they are, you have a bit of products, we have extra storage for you to store most of the products. So the shelf acts as your display point, so that when customers come, we give them a holistic shopping experience. If you want to buy shoes, we have, tens of businesses who are all selling shoes. So able to give the customer incredible, choice, making the shopping experience better. It's 3,000 shillings on a monthly basis. For the spaces we have, you'd see, we have places where we pay, north of 200,000 shillings, but still people pay 3,000 shillings. So you can imagine the price difference is that it becomes affordable, it becomes a more efficient way of doing business.
Naomi Mololo has taken space at the business. She sells clothes for men, women and children imported from Turkey. Today, she's here to check on her stocks. Naomi has never opened a physical shop, and she heavily relies on social media to market her products, which are then delivered to buyers by Notify Logistics.
They have made my work easier, especially on the delivery side. They help me with the deliveries, they package, they deliver to any part. It has made my work to be easier. I don't have to deliver to the clients daily. I don't have to come here. If I get an order, I'll just send them the information and they'll pack. The client will also pay. So it has really helped to expand my business. I've got a lot of more time to work on marketing.
I'm an economist by training. So there's a new concept called the sharing economy. Sharing economy is built on one concept of efficiency. That if you're able to use the resources more efficiently, you can actually reduce the cost of using that particular service or product significantly, while still making a decent profit of it. So what we do is we allow hundreds of small businesses to co-share one space. And just by making it efficient for hundreds of people to be in one space without it becoming a nuisance, we're able to, one, reduce the cost because everyone pays for the space they are using. So you don't really care about the whole shop.
Renting a shop is much expensive, mostly here in Nairobi, because renting a shelf is easier and cheaper. You can able to install your products there, they are safe. Then they have a lot of assistants. They can able to sell it for you, and you do other things on the other side.
Any business wants to be a place where you're selling more. That is the most fundamental truth for any business. What we offer small business is, one, a place where you're able to leverage traffic from many other small businesses. You're not alone. The reason why places like Komba are popular is because these are places where you find hundreds of people selling the same kind of product. And so they're able to drive in a more significant crowd than when you're in your own independent shop.
What started as a quest for Waweru to find space in the CBD for his wife's business has now become a solution for hundreds of small businesses. He is now scouting for bigger spaces in different regions to expand his business and continue providing spaces for small businesses. Well, this has proved to be quite a solution, especially for small businesses who are yet to find ways to fund for a shop in the CBD and pay the high taxes and the licenses. Well, let's take a look at our leading indicators for this week, starting up with Forex and stocks. Let's take a look at the prices of groceries across different supermarkets this week. Well, that's all that we had for you this week. This is Moolah Insider, and remember to log on to www.moolah.co.ke. We have so much in store for you there, and this week we'll be focusing on the national budget, and we will be updating you next week.